This LOS is described factors that influence the level and volatility of yield spreads. Credit risk versus return, yields and spreads. The higher the credit risk, the greater the offered required yield and potential return demanded by investors. Over time, bonds with more credit risk offer higher returns, but with greater volatility of return than bonds with lower credit risk. The yield on a credit risky bond comprises the yield on a default risk-free bond with a comparable maturity, plus a yield premium or spread that comprises a credit spread and a liquidity premium. That spread is intended to compensate investors for credit risk, risk of default, and loss severity in the event of default, and the credit risks related that can cause spreads to widen and prices to decline, downgrade or credit migration risk, and market liquidity risk, okay? So the yield spread equals the liquidity premium plus the credit spread. In times of financial market stress, the liquidity premium can increase sharply, causing spreads to widen on all credit risky bonds, with lower quality issuers most affected. In times of credit improvement or stability, however, credit spreads can narrow sharply as well, providing attractive investment returns. So let's just do a quick practice question to check our understanding. Credit yield spreads most likely widen in response to A, high demand for bonds, B, weak performance of equities, or C, strengthening economic conditions. I think that question should be fairly easy. Credit yield spreads will most likely widen in response to weak performance of equities. In weak financial markets, including weak market for equities, credit spreads will widen. If we look at high demand for bonds, if there's high demand, that will narrow the spreads. And if economic conditions are strengthening, again, that will narrow the spreads. Credit risk versus return, continue with the yields and spreads. Credit curves, the plot of yield spreads for a given bond issuer across the yield curve, are typically upward sloping, with the exception of high premium priced bonds and distressed bonds, where credit curves can be inverted because of the fear of default, when all creditors at a given ranking in the capital structure will receive the same recovery rate without regard to debt maturity. So the impact of spread changes on holding period returns for credit risky bonds are a product of two primary factors: the basis point spread change and the sensitivity of price to yield as reflected by end of period modified duration and convexity. We saw that in the previous reading, how to calculate the modified duration and the convexity. Spread narrowing enhances holding period returns, whereas spread widening has a negative impact on holding period returns. Longer duration bonds have greater price and return sensitivity to changes in spread than shorter duration bonds. So recall the price impact equals negative brackets modified duration times the change in spread brackets plus 1/2 the convexity times the change in spread squared, okay? Another quick practice question. This one should be fairly easy. The factor that most likely results in corporate credit spreads widening is A, an improving credit cycle, B, weakening economic conditions, or C, a period of high demand for bonds. Okay, that question should be easy. It's very similar to the last one. B is correct. Weakening economic conditions will push investors to desire a greater risk premium and drive overall credit spreads wider, okay? So it's looking at credit spreads widening. Improving credit cycle, no, that would narrow them. And a period of high demand for bonds, no, that would narrow credit spreads as well. So B is the correct answer. So we'll have a bit of a review slide and then one last practice question to finish this LOS. So the yield on a corporate bond equals the risk-free interest rate plus expected inflation rate plus maturity premium plus liquidity premium plus the credit spread. So the yield spread equals liquidity premium plus the credit spread, okay? So the spread seems to be more volatile for lower quality bonds than for higher quality bonds. And the factors affecting the yield spreads are 1, the credit cycle, 2, the broader economic conditions, 3, financial market performance, including equities. 4, broker-dealers' willingness to provide sufficient capital for market making. And finally, 5, general market supply and demand. And one last practice question to finish this LOS. Which bonds are likely to exhibit the greatest spread volatility? A, bonds from issuers rated AA. B, bonds from issuers rated BB. Or C, bonds from issuers rated A. This is a nice question to end on because it gives us a little review from a previous LOS in terms of the investment grade, non-investment grade, and how the ratings are for Moody's, S&P, and Fitch. This one doesn't tell you what the ratings, but it looks like obviously it's using the S&P and Fitch nomenclature because they're talking about AA, which we have here. They're talking about BB, which we have here, and they're talking about A, okay? So it says which bonds are likely to exhibit the greatest spread volatility. Recall from the previous slide, it said that spreads seem to be more volatile for lower quality bonds than for higher quality bonds. So we're looking for the lowest quality bond on this list, and it's the BB. Okay, you can see the ranking. AA is the highest. A, those are both investment grade. The BB here is non-investment grade. It's got the lowest quality, so B is correct. Lower quality bonds exhibit greater spread volatility. All of the factors that affect spreads, the credit cycle, economic conditions, financial performance, market making capacity, supply and demand conditions, will tend to have a greater impact on the pricing of lower quality credits, okay? And that's the last slide for this LOS. Thank you.